Hey everyone, we're here with Alex, founder of IDEX. He'll be doing a talk on liquidity wars, order book versus AMM. Once he starts talking, can you guys just confirm that you can hear him? And Alex, do you want to share your slides?
Yeah. All right. Hey everyone. This is Alex Warren from IDEX. Can you see my slides all right? All right, looks like it's sharing. And can everyone hear me okay? Perfect. Thanks everyone. All right, we'll jump in here. So thanks everyone. I appreciate you taking the time here. I know it's been midway through a long weekend, so hoping to entertain you a little bit with a little more information on my perspective around liquidity, and in particular, order books versus AMMs. So this has been a pretty hot topic the last couple of weeks. Lots of people weighing in, and so I wanted to give my perspective. I'm the co-founder and CEO of IDEX. We're an Ethereum decentralized exchange, and I think I've got some unique insights into liquidity, and in particular, these two different models of exchange design. So just a quick overview of what I'm going to talk about. First, just make sure everyone understands and level sets what market making is and how market making works. We'll discuss central limit order books, both the centralized and decentralized version. We'll then move into the rise of the AMM, the automated market maker, and then end with a little bit on the future of decentralized exchange design. So first off, just want to level set and make sure everyone understands what is market making. And it's actually literally exactly what it sounds like. Traders in the market who will make the market by ensuring there is always a set of orders to buy or sell into. So in this example here, we've got an asset whose market price is $100. The market maker would set a buy order of $99, a sell order of $101, and those orders will sit there so that other buyers and sellers, takers in this case, can enter the market and trade against those orders. Now, the goal as a market maker is to do this a bunch of times back and forth so that you can make money off the spread, the difference between these buy and sell orders. And the process is a bit of a trade-off. So if you have tighter spreads, say this was $99.99, you might get more trading, because anytime a taker has to trade against these orders, they do what's crossing the spread and actually, losing a little bit. If it's a $100 asset, you're actually only getting $99 if you sell into this buy order. So tighter spreads might encourage more trading, but you're going to have less profit per trade. And now the key thing is that these market makers are always in the market. So they're really trying to perfect their behavior in order to have an ROI on these assets. They're tying up capital in order to offer these orders. So in this case, they have to offer both $99 as well as 1 unit of the asset for buying and selling. And so you can get stuck in these assets and keeping them on the balance sheet. So a lot of it is how do you manage that risk of keeping spreads tight enough to ensure trading while making sure that the market doesn't move against you too much. So now most of you are probably familiar with the most common way that market makers signal their orders to the market, which is through the central limit order book. Now this is historically how exchanges have worked. It's an aggregation of all of the resting limit orders into one shared view. So you can see on the right-hand side, these are all individual orders from market makers, and then takers have the opportunity to cross the spread and actually take some of that liquidity off the books from those market makers. Now, what's interesting is everyone thinks as market makers as kind of predatory traders in the market, but it's actually takers that have the upper hand. And there's a great article in Deribit Insights that talks about this in more detail, but it boils down to the fact that takers don't have to make a trade. So market makers, in order to make money, have to always be offering orders in the market, while takers get to choose to not trade in certain conditions. And the fact that they are trading, by definition, means they know something that the market maker doesn't. So they have a reason for making a trade that isn't yet reflected in the sum of all the available markets. And it could be any number of things. They could be executing multiple large orders or a big order on multiple different venues. Maybe they're lifting orders off a bunch of different exchanges at one time in order to get a better execution on the order. They may have some unique insight into what's coming next in the market. So they might have a good predictive model that allows them to make a prediction that others don't have on what direction it's going to go. Or maybe they have some inside information. They have some unique perspective on why the market's going to move one way or another. Or it could just be that it's a trader that doesn't have any specific extra knowledge. They're just acting on a naive view that they want to buy or sell a particular asset. But regardless, taking liquidity itself is by definition introducing some new information into the market that wasn't previously reflected. So as a maker, your goal is to identify and protect against what's known as toxic flow. So in these examples above, you want to have as many traders as possible who are just acting on a naive view, nothing specific, no unique information that you don't have, and you want to avoid the adverse selection that can come from takers who have an information advantage. Now, this toxic flow doesn't just happen in crypto markets. It exists in all markets, and sometimes it comes from some odd, unexpected places. So you may have seen this tweet from Elon Musk. Funding secured has become a bit of a meme now. Actually, once he tweeted this, Tesla jumped by 9% in value almost immediately following this tweet. So this is an example of additional information that those who saw the tweet had and those who missed it did not have. So if you were a market maker on Tesla selling Tesla shares, you were almost immediately out of the money. And if you had some sort of mandate to have a certain number of shares available for buying and selling, you were scrambling to get balanced again. And so this is an example of why a lot of these things are regulated. They want the market regulators want to make sure that everyone has a fair opportunity to gain new info. So if you think about things like earnings calls, where executives who have inside information about stocks and companies will actually report them on a specific cadence, and they're barred from trading outside of particular windows. That's exactly to make sure that participants in the market have equal access to information and that others don't gain what's seen as an unfair advantage. So the question becomes, as a market maker, how do you go about protecting yourself from toxic flow? And you actually protect yourself in the same way that toxic flow is generated. And it's really about being fast. So the first is you want to reduce latency. So if something happens in the market, you want to be able to respond quickly, whether that's the tweet from Elon Musk, or maybe you're seeing trade activity that's aggressive and unexpected, and you want to be alerted to that and have your systems respond as quickly as possible. The second is about increasing your knowledge. So whether that's different sources of news, or more commonly in trading, being plugged into a bunch of different markets. So imagine you're plugged into 5 different cryptocurrency exchanges. You see the prices going up quickly on 3 of them, then you can react and make the appropriate moves on the other 2, so that you can have all of your orders be in the right position for those quick price moves. So ultimately, it's about speed of information, being able to identify, ingest, and react quickly to new knowledge in the market. And so when you think about this, it's no wonder that centralized exchanges look like they do today. Everyone plugs into one central matching and execution engine. All of the market makers have built up pretty robust systems that can allow them to interact very quickly and precisely with the underlying exchange infrastructure. And it also sheds some insights into why early decentralized exchanges that tried to replicate the central limit order book on chain didn't work very well. So early DEXs, my co-founder was part of EtherX, which is one of the very first Ethereum decentralized exchanges. And they tried to replicate the central limit order book design in a fully decentralized way. So the way to think of it was that the entire system of the exchange, not just custody and settlement, but also things like the order book and trade execution, were built using smart contracts. What that meant was there were a lot of drawbacks due to the underlying performance characteristics of the Ethereum network. So every time you wanted to pay or place to place or cancel an order, you actually had to pay a gas fee to the network. So this made it expensive to update your bids and asks as a market maker. You also have to wait for things to mine every time you place a transaction. So this is high latency. Both of these are things that you don't want as a market maker. The result was that it was easy to get picked off, especially if prices move elsewhere. You then have to race and pay in order to remove your order and then update it to a more realistic price. So you have to pay to do so. You don't want to do it very often. And every time you do pay, it's going to eat into your profits. So the results are, in hindsight, not too surprising. You ended up with high spreads and limited liquidity. No one's going to want to make markets in that environment where you're at such a disadvantage to market makers on other more performant exchanges. So around this mid 2018 or early 2018, we had the introduction of a new type of exchange that was actually a unique or creative response to some of the constraints of decentralized networks. So I lifted this graphic from an article from Bancor. They were one of the very first automated market makers. Now, an automated market maker doesn't have any order book at all. It's just using a formula to actually offer orders or offer assets for buying and selling. A user, a liquidity provider, as it's called, will deposit two assets into a smart contract, and the ratio of these assets helps determine the price. These assets are then offered to others based on, as I said, a fixed formula, which this makes a smooth curve. So you see in this graphic, we have a traditional order book in the back, which is an aggregate of individual market makers and their specific offers. And then you have the representation of the smooth curve represented by the Bancor formula. Now, users can just buy and sell automatically against this pool of assets. Now, there's a couple interesting properties. First off, prices of the automated market maker never update independently. So unlike a central limit order book where makers are updating orders constantly, these prices don't change until someone actually makes a trade against the curve. And in this example, you can see someone came in and bought, which moves the midpoint of the curve up and to the right. Or if someone sells, it would move the curve down. So this is great in an Ethereum-like environment where it's costly and slow to update things. So you only have a transaction when you actually want to have an order taken from the books. But at first glance, it sounds like this shouldn't really work. If you recall from our orders or from our previous discussions, one of the main things that you need as a market maker is the ability to update your prices and protect against toxic flow. In this case, you're always offering liquidity and pretty much guaranteed at a stale price until someone shows up to arbitrage this. Now, looking at the returns of a portfolio in a liquidity provider position on an AMM, it would seem to support this idea that you're never going to win. So this curve shows based on the x-axis, which is the ratio of the two assets in the AMM, based on changes in that ratio, what happens to the value of the portfolio. And the key thing here is that it's capped at 0 at the starting point, and no matter what direction the price moves, the portfolio is going to decrease in value. So it seems to confirm this idea that you're guaranteed to lose money. But what this analysis ignores, is the fact that you actually are earning fees as an LP. So in the Uniswap AMM model, liquidity providers collect a 0.3% or 30 basis points fee on each trade. And these fees can add up over time. So this curve shows the same curve as that last one. You see it's got the same shape, but this is for the ETH DAI Uniswap pool, inclusive of fees. And you can see that what it does is it shifts the curve up so that a large portion of it is actually above the baseline 100% portfolio value. And then you can see in the blue line below, it actually shows the range of fluctuation in ETH price that can occur while still allowing for LPs to be profitable. Now, there's this cool time series here that shows this even a little bit better. So the red line is the accumulated fees to liquidity providers. And you can see that steadily increasing over time as users trade against the pool. The green line shows the ETH price. The key here being that throughout this time period, it started off dropping before eventually slowly climbing back up, but never quite getting back to where it started. The blue line is the portfolio value excluding fees. You can see that as soon as the ETH price starts dropping, so does the portfolio value, and it actually never gets back to 0. But then last you have the orange line that includes fees, and you see that over time it starts to diverge from the blue one and eventually goes positive near the end. So what's going on here, I think I like this chart because it kind of tells you a little bit about circumstances under which being an LP for something like Uniswap is a good idea and when it's a bad idea. The position wins in certain conditions and loses in others. The basic things you want as a Uniswap LP is you want a lot of volume. So you want a lot of fees, right? That's going to be what accumulates fees, is trading against this pool. And you want very little volatility. So your long volume and short volatility, or more precisely, you're long the ratio of volume to volatility. The idea being that some level of volatility is going to exist. It's unrealistic to expect the prices of these assets, or in most cases, expect them to stay exactly the same. So you are hoping that the volume and the fees generated by it are enough to outpace and overcome whatever volatility exists. We also have this great illustration by user Fiscantes on Twitter about what's good for a Uniswap LP and what's bad for a Uniswap LP. You can see on the left, in both of these circumstances, there's a fair bit of volatility in prices, but eventually they converge back to equal one another. Whereas on the right side, you have these two tokens diverging, in which case the change in the volatility and the change in price ratios is too much to be overcome by fees. So what are some conclusions we can have from AMMs themselves? First off is that it's very simple, which is, in this case, a very good thing. It's great for overcoming some of the shortcomings of the Ethereum network, in particular, the high latency and high fees associated with placing and canceling orders on an order book. Much easier to support it via an AMM. It also allows for one-click participation from your average user. So there's no infrastructure required. You don't have to have a sophisticated setup or knowledge in order to participate. It works really well for what I call equivalent assets. So these are going to be things like stablecoin pairs, DAI versus Tether, or wrapped BTCs, wrapped BTC versus REN BTC. If the assets are expected to be the same price, then it's going to get a lot of trading volume and very unlikely to have issues with volatility and prices diverging from one another. But users still need to be careful of black swan events. So it's interesting that ETH has been somewhat range bound during the last 2 years of AMM kind of growth, anywhere mostly between $200 to $400 and between 100 and 500 at kind of their peaks. Crypto tends to move pretty violently at times, so it'll be interesting to see what happens to LP returns and how people respond if and when we get more aggressive up and down movements in prices. So we talked about two different models and kind of the conditions under which they work well and which they don't. And so I'll leave you a little bit of thoughts on kind of the future of DEX design, as that's what we're focused on here at IDEX. So it's clear to us that prioritizing liquidity is key, and attracting market makers and liquidity is kind of table stakes for having adoption of your platform. So we think it's going to kind of grow and continue in 3 different directions. So the first is replicating central limit order books on faster chains. So an example of this is Serum operating on the Solana network. The idea here is that if the Ethereum throughput, cost, latency, etc., if those are prohibitive to having a central limit order book where market makers can actually successfully provide liquidity, what if we speed up the chain, get something that's more performant in hopes that it will actually be more suitable for those activities? Some questions still remain around it. In particular, is it fast enough and precise enough? It's never going to be as good as a centralized matching and execution system. So is that good enough for deep liquidity? And in the case of something like Serum, it's separate from the Ethereum environment where all of the activity, the assets, and trading is currently happening. So interesting designs, and definitely a cool opportunity to keep an eye on, but has some challenges to overcome. The second that we're going to see a lot more of is around AMM innovation. And you're already starting to see that with a bunch of different competitors to Uniswap. So you have things like new curves and designs. So you can actually change the formula that you're using to offer liquidity. Curve is a great example of this, that has one that is really well designed and suited for assets that are expected to stay the same price. However, I think these will long-term be at a disadvantage, given that these assets tend to trade in multiple venues, and LPs on AMMs are, I guess, more constrained in terms of the options that they have to react to exogenous events. So as I said, we'll be watching this closely to see how they respond during more turbulent market conditions. And then lastly is what we're working on here at IDEX, which is what we call a hybrid design, where we're trying to bring the performance of a centralized exchange and marry it with the security of a decentralized exchange. We do that by having a very specific type of architecture. So it's bringing the off-chain components of your top-tier centralized exchange, that's the order book, matching engine, and execution process, and pairing that with smart contracts for just custody and settlement. So, of course, nothing is free, right? We're making some trade-offs here in terms of decentralization in order to get that centralized exchange performance while still staying non-custodial, ensuring that we never have to take custody of users' funds. And for those that are interested, IDEX 2 actually goes live in 2 days on Tuesday, October 20th. So we're pretty excited about this. It's much more than just a layer 2 exchange. So if you've heard about L2, that really only provides scalable settlement, meaning it's cheap to settle trades on Ethereum network. But you also need infrastructure for market makers and liquidity providers to compete, as we've discussed. So to do so, you got to make it easy for them to place and cancel orders. They have to be able to do it for free, and they have to be able to do it immediately. So think about the issues from earlier with respect to toxic flow and how we protect liquidity providers from toxic takers by giving them a low-cost, high-speed environment. So we're pretty excited about this because the result is a platform with the capability of matching the liquidity, the depth, and spread of a centralized exchange, but without having users give up custody of their funds. So again, this launches on Tuesday, so please come check it out and take a look. All right, so I hope that was helpful. Hope you guys had some insights out of that. Let me know if you have any specific questions in the chat. Maybe in the meantime, I'll just talk a little bit about a few other interesting misconceptions that I've seen just working with market makers. So a lot of people think that market making is about wash trading or spoofing orders, pumping and dumping. And that's definitely not market making. So in any sort of regulated market, and if you work with a respectable market maker, the only thing they're going to do is put orders out there for buy and sell. They're not actually going to be trading against themselves. That's actually highly illegal in regulated markets, and I would say very frowned upon and not allowed on reputable cryptocurrency exchanges. So it's interesting to hear people sometimes rail against market makers as these nefarious actors, when in reality, without market makers, it'd be very difficult to see crypto markets functioning properly. You'd see liquidity dry up, spreads would explode. Ultimately, it would not be anywhere near the level of success that it is today if it didn't have those participants. Yeah, so PK article on takers versus market makers. Yeah, so Google, I think you're talking about the Deribit Insights one. I'm trying to remember the exact link. So check out Deribit Insights. There's one on AMMs, and there's one on, there's a line in there about where the market makers' yachts. The joke being that takers are generally at an advantage. And when you hear about HFT firms making billions of dollars, it's generally the guys on the taker side, not the market makers. Question from Fox. Yeah, so on IDEX 2.0, so we're partnering with some market makers for some of the top assets in order to make sure that there's good liquidity. Again, this was based on feedback from them on what they need in order to be able to provide tight quotes, very tight spreads and deep order book liquidity. We're also working on some tools. So I know Hummingbot is one of the sponsors of this event. They have a really cool product that makes it not quite as easy as an AMM, but really kind of democratizes the liquidity providing process for people on exchanges. We're going to be integrated with them within a couple of weeks, which will make it easy for projects and fans of particular projects to provide liquidity themselves.
Cool. So if there are any last questions, please drop it in now. Otherwise, what we can do is transition to our break.
Sounds good. Well, thanks everyone. I appreciate the time and enjoy the rest of the sessions.
Awesome. Thanks, Alex. So
Yep.
we'll be taking a short 30-minute break, and then we'll be transitioning to QuantStamp, who will be doing a talk on $26 million in losses so far, but the future is still DeFi. And thank you.